Today on Your Money, Your Wealth podcast number 366, does it make sense to use the money you would have contributed to a Roth IRA to pay the tax on a Roth conversion instead? Does the IRS really penalize ineligible Roth contributions? How will a mega backdoor Roth contribution be taxed? And will the step transaction doctrine apply? Are family Social Security benefits affected if the spouse works? Plus, $1,800 a month for life or $2,600 a month for 10 years. Joe and Big Al spitball retirement pension options, and they take your comments. Visit yourmoneyyourwealth.com to send your money questions and comments as an email or as a priority voice message. I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
I think Lee from Jacksonville, Florida, left us a message.
Hey, Andy, Joe, and Al. Quick question from Jacksonville, Florida. We have a Roth IRA with $130,000, a traditional IRA with $120,000. We are currently in the top, near the top of the 22% tax bracket. We've been trying to convert IRA into traditional IRA pieces at a time, about $20,000 a year. But we're getting to the point where we're probably not going to get done by the time the tax hikes occur when they expire in 2026. So our question is, instead of contributing the $12,000 a year to Roth IRAs, $6,000 into my wife's and $6,000 into mine, should we just bite the bullet and convert as much as humanly possible into the Roth IRA from the traditional, using the $12,000 for taxes that we would have contributed to the Roth? We could probably complete it in about 2 years, except we would not be contributing to the Roth. We would have just rolled over everything from the traditional. Really appreciate any spitballing you can give. I am currently driving in my silver Tacoma. I'm not drinking because that would be bad. And we have 2 cats. I emailed before, but figured I'd give you my voice this time. Lee from Jacksonville, out.
Lee. Yeah, nice to hear your voice, Lee. All right. He's cruising around in Tacoma, thinking about converting. So he wants to use some leverage.
Sure.
I like the strategy, but I don't know if it makes sense.
Okay.
So
what do you say?
Well, a couple of things. What Lee is trying to do is to get all of his money from the traditional IRA to the Roth. So he's got $120,000 in his IRA. He's got $130,000 in the Roth, and he's like, hey, let me bang this thing out. Let me convert $20,000 a year. And over the next several years, that 120 is now all going to be in a Roth IRA. I'll pay the tax and we'll be good. I like that, but he doesn't necessarily have to convert 100% of the IRA. It doesn't make any sense.
Right.
So what the strategy he's talking about makes sense for a lot of people, but I don't think it makes sense for Lee. So what Lee wants to do is say, you know what? I'm making Roth IRA contributions. We're making $6,000 contributions per year for the spouse and I. So instead of taking that $12,000 that would have went into a Roth, maybe we convert $30,000 and we'll have a tax bill of $12,000. Instead of contributing to the Roth, we'll just take that $12,000 and we pay the IRS to get the $30,000 conversion in the Roth.
Right.
So, I mean, I don't have a calculator. I just kind of totally made that number up.
Close enough. I mean, maybe it's $40,000, but that's the concept, right? So believe it or not, I agree with you. And the reason is because you don't have to convert everything. I mean, if that's your goal to convert everything, great. But in this example, you got $120,000. I don't know how old you are, Lee, but let's just say, first of all, let's just say you're in your 60s.
Lee's not in his 60s.
I know, but I'm going to give 2 answers.
Did you hear his voice?
No, but I'm going to give 2 answers because for our other listeners, in your 60s, it means that your RMD is relatively close. It's probably going to be no more than $5,000-$6,000 for a year. So it's not a big number. Now, on the other hand, if you're in your 30s or 40s, which you probably are, then it's going to grow a little bit more. The RMD, required minimum distribution, when you finally get there, will be higher. But you don't have to convert everything, because what happens is you're paying, by converting, you're paying taxes in a 22 or 24% bracket in order to save a 12 or 15% bracket later. So that's first of all. The concept, though, I agree with, which is if you've only got a little bit of money, should you do a Roth contribution or should you use it to pay the tax on the conversion? I actually would prefer the tax on the conversion, because then your $12,000 can get $30,000 or $40,000 converted instead of just the $12,000 going into Roth. So I like the concept. I just don't think the numbers are high enough to justify it.
So we're missing a lot of information, Lee. First, I think a lot of you just like to give us the IRA numbers, but you might have $2 million in a 401k.
Sure.
Right. Or there's other retirement accounts, or there's pensions, or there's other income. So we have to map out the entire scenario for you really to understand it. He's kind of looking at it in a bubble.
Right.
It's like, hey, I got $120,000 in this traditional IRA. He might have several other retirement accounts. I don't know. And I don't know if Lee's given us more information in the past. But we would have to look at the entire picture. If this is just a picture of only 120 here, your distributions, the force out on the distribution is not going to be that bad where it's going to pop you into another tax bracket where, you could slowly do the conversions. You don't have to get 100% of it in the Roth. But I like the concept.
Yeah, well, that's a good point. Like, let's say you had $2 million in a 401k, then it would be completely different advice. Then I would say, yeah, it's a great plan, because you're going to want to bleed out as much as you can. And I'd rather have you use the $12,000 to pay the tax on a conversion than do the contribution.
So yeah, I think for other listeners out there our listeners love the Roth.
Well, it's because you taught them to, Joe.
And so they want to look at every strategy possible to leverage the Roth.
Sure.
And
they like tax-free.
Yeah, I like Lee's point. And I think a lot of people probably should be looking at that strategy. So again, instead of taking the $12,000 from cash flow to go into a Roth contribution, let's say that's the only thing that they can afford, right? There's no extra cash flow. That's what they're going to save. That's what they're earmarked for, saving up $12,000. Does it make sense for them to convert or to add to their savings? Well, are they on track for their goals? First of all, do they need to use that money to continue to build their nest egg? Well, that's an obvious, right?
Sure.
But if they're close and they accomplish their goals, and then they want more diversification, well, then you want to use that or some or part of that to do the overall conversion. I got Jim writes in. He goes, "Hello, YMYW. I'll get right to the question to keep Joe's reading to a minimum."
Thanks,
Is that
Jim.
a little bit of a dig?
I think so. My brother was unaware of the income limits of contributing to a Roth IRA. Oh, of course, it was your brother.
Always the brother.
It's always the brother. He is able to recharacterize his 2021 and 2022 contributions. However, he's been making these ineligible contributions for the past 10 years.
Ooh.
Wow. Jim, how do you know all this about your brother?
They're tight.
Super tight.
They're twins.
I'm aware of the 6% penalty per year, but am curious to the checks and balances of this heir since it has gone unnoticed for so long. I heard on other podcasts that I write into and saying that my brother has made it over. He did write that. I heard on other podcasts that in reality, he would most likely never have a problem leaving the Roth IRA contribution from the previous 10 years. Thanks for all the info you provide. All right, let's help out Jim's brother here. What would you do? What would you do, Alan?
Well,
if you were Jim,
me,
AKA Jim's brother.
Yeah, let me explain what this means. So there's certain income limitations on doing a Roth contribution. So for 2022, it's, I think, 144,000 single. When you get to that income level, you can't do a Roth conversion anymore. Then there's a contribution. Thank you. And there's a phase out before that for a married couple. I think it's 214. Yeah, 214, I think. Anyway, so let's say you make more than that and you do a Roth contribution. Then what the IRS says is that by October 15th, their filing date, you've got to take it out. You've got to recharacterize it. You have to take it out because you weren't allowed to. And if you don't do that, year after year, you have to pay a 6% excise tax. So if it's 10 years, it could be like 60% of the account. And it's worse because of compounding potentially, right? So that's the problem. If the IRS comes after you, they're going to say this is disallowed. we're going to take all this out, and you're going to owe us this penalty, which probably in 10 years is going to be at least 60% or about 60% of the value. So that's the risk. So the question is, should you do that? Should you go ahead and pay that, which sounds painful? Or should you just kind of hope it never comes up, which is what he's asking, because he's heard that on other podcasts. I will answer it this way. You are correct. The IRS does not have a very good checks and balances on this. So I'm not going to tell you what to do. There's a risk that this whole thing could blow up in a few years when the IRS catches up with it.
I would say if Jim does the right thing and says, you know what, my brother
right
was unaware of the Roth contribution limits, right? Income limits, and asks for forgiveness, I would imagine that some of this could come out without the 6% excise tax.
It's possible,
right? Is saying, you know what, I made a mistake. I'm coming clean. I'm going to just recharacterize all of these dollars out. I will pay tax on whatever earnings that the Roth IRA has, grew to. And then now the money sits outside. Or you could recharacterize, those 10 years or 60,000 or whatever the I'm not sure how old Jim's brother is. So, you could recharacterize those back into the IRA, right? And then you'd pay tax on whatever the earnings are. So there's different options here.
Sure.
Or you can just let
it go and see what happens. Start doing it right on a go forward basis. I think that the best answer is to check with your tax professional, whether that's a CPA or whether that's a tax attorney. Get their thoughts. They're probably going to tell you to pay the excise tax because that's the right answer. What you should do, we just told you, you've got a couple choices.
It's the honor system.
Yeah. But the IRS, I will say this, I've actually never seen them catch this sort of thing, but that doesn't mean they couldn't start, right? So there's that risk.
What would you do?
Putting me on the spot?
He would have never gotten it wrong in the first place because he would have known.
I would contact my tax professional.
Got it.
Get their advice.
I'd let it ride.
I probably would too.
Yeah, I would,
I would start doing it correctly on a go forward. I would I don't know if it recharacterized the last couple of years, but I would stop doing it on a go forward basis. For sure. I mean, at an absolute minimum. But then you're just taking a chance.
Yeah.
Some people can live with that. Others can't.
I don't know how you can sleep, Jim. I don't know how you can. I don't know how you go to bed at night. Yeah, I mean, that's a tough one. It's like you made an honest mistake and
Sure.
you could get blown up. But if you come clean, in most cases, you say, you know what, I made a mistake.
I didn't know this.
Like with RMD, that happens. If you forget to take an RMD or something happened, or you had an extra account where you didn't take you could file for certain things without the huge tax penalties. I mean,
Right.
if you don't take a required distribution, it's a 50% tax penalty. So there's exemptions or
And we do
exceptions.
We do know that one. If you don't take your RMD, right, 50% penalty. Typically, the first time that happens to you, you get one pass, and it's not guaranteed, but the IRS very often abates that penalty.
But right now, what they're doing is that they're filing a 5498 every year, right? Isn't that what that form is?
Yeah.
To look at, here's the contributions, or here's your IRA balances and everything else. So over the last couple of years, they're getting super tight.
They're getting tighter.
Where the money is in all of these accounts. And
Yeah.
they're going to cross-reference, okay, well, you made a Roth contribution or you have money into a Roth, and here's where your income lies, right? It's like, I don't know.
That's right. That's the thing. Can you sleep with this
Right.
issue or not?
Yeah, and then the auditors are going to come, and then they're going to play the tape. And then it's going to be our podcast and all the other podcasts Jim writes into.
That's why I didn't want to say what I do. But
Yeah.
anyway, whatever.
Well, that's why we said do the right thing and talk to your CPA. And, of course, Al and I would always do the right thing ahead of time. We would never make this mistake.
We know about the rule.
All right. Thanks for the question, Jim.
Learn all about how Roth contributions and conversions give you tax-free growth on your investments for life. Download the ultimate guide to Roth IRAs for free from the podcast show notes at yourmoneyyourwealth.com. And subscribe to the YMYW newsletter there in the show notes as well, so the latest podcast and TV episodes show up right in your inbox. Your Money, Your Wealth TV Season 8 starts this Sunday with a retirement disconnect. Sometimes when planning for retirement, what you are doing and what you should be doing don't match. Joe and Big Al will show you how to reconnect that plan so that your retirement picture comes together as it should. Click the link in the description of today's episode in your podcast app to download the ultimate guide to Roth IRAs, read the transcript of today's episode, and subscribe to the YMYW newsletter. It's all free, all courtesy of Your Money, Your Wealth and Pure Financial Advisors. Share this stuff and help us spread the YMYW word, won't you please?
We got Juan from Illinois. That's Juan, right?
Or Yuan.
Yuan?
Yuan?
Yuan. Any opinion now?
Yeah, Juan, I would say probably.
Y-U-A-N. Okay.
Yeah.
It's usually J, but
yeah.
All right. Hi, Alan Joe. Love your show. It's entertaining and educational all at once. I learn a lot. Thank you. I have a couple of questions about a rollover after tax 401k to IRAs. Okay, a little background information. Have Roth IRA and traditional IRA. Traditional IRA has zero balance. 401k plan at work, pre-tax 401k, Roth 401k, after-tax 401k. It's got about a $20,000 contribution, $50,000 gain, can no longer contribute to the after-tax component of his 401k plan. What I would like to do is roll over the $20,000 non-taxable contribution to the Roth IRA and the $50K taxable gain to the IRA. Well, of course he would. There, one. Number two, roll over the IRA back into my pre-tax 401k before year end. This is because I did the backdoor Roth conversion in January 2022. Okay. My 401k plan allows the above in-service rollover. My questions: will it result in any tax? Should I be concerned with step transaction? Oh, look at Juan.
Yeah, doctrine.
The doctrine of the steps. Looking forward to listening to you on the podcast. Thank you in advance for your advice. Juan, we don't give advice here. That's one thing we do not do.
We spitball.
We chat.
We chat is right. It's about it. We give our thoughts off the cuff.
Yeah. Advice is something completely different that you should pay a professional for.
True.
Not write in half-ass questions to a bunch of knuckleheads. This is not advice whatsoever. Okay. So what should he do or she do?
Yeah. Well, let's see. I'd like to roll over 20,000 non-taxable contribution to a Roth from the 401k and 50,000 to an IRA.
Because it's $70,000, right?
Yeah.
So she's made, or Juan has made contributions of $20,000. It's
Sure.
worth 70.
Sure.
They want to split it. It was like, well, here, I just want to put $20,000 of the after tax in the Roth, and then the 50,000 going to put it in an IRA, and I'm
Yeah.
going to avoid the tax.
Yeah. So that works.
I don't think it does.
You don't?
No way.
Why not?
Because the $50,000 of gain came from that $20,000. Remember before you had to do all these kind of hoops? That's why you got to convert the after tax right away, because if you have any gain, it's going to be taxed. So what I would do if I were Juan.
So I read that differently. I was thinking it was a after-tax contribution, but I guess he says non-taxable contribution.
It was an after-tax contribution, but he's never converted the after-tax contribution. The after-tax contribution has grown now to 70.
Yeah. So, but okay, I was thinking, but is this a 401k or an IRA? It doesn't say.
After-tax 401k, 20K contribution, 50K no longer contribute to this. So you're saying he could take the $20,000 of after tax, even though that $20,000 grew to 70.
Not in an IRA, in a 401k.
And so you could separate the contribution and the growth and say, here's the contribution, put it into the Roth, and the $50,000, move it into.
In a 401k, the after-tax contribution, you could put that into a Roth IRA. The growth has to go into a regular IRA.
Okay, I buy that.
Okay. That's where I was coming from.
Got it. Okay. And so he just gets 2 checks and put the 20K into the Roth, 50K in, and then he wants to roll the 50K back into the 401K because he did a backdoor Roth.
Sure.
And then when the backdoor Roth is going to mess up his pro rata rules.
Sure.
I think he can do that as well.
Me too, as long as it's done by year end, because it's your IRA balances at year end that count for the backdoor Roth calculation.
The only biggest issue here is that they changed the rules, which is on the docket, right?
Well,
So
that they
backdoor Roths,
I know, but
you know, the mega board. I mean, so what he's trying to do is the mega backdoor.
yeah, true.
So he's got the 20,000 of after tax that he never converted. So he's like, okay, well, here, can I move that $20,000 again? The 50,000 of gain. I mean, when did he do this backdoor Roth? I mean, when did he do the after tax? I wonder. Or Yuan?
Well, I don't know, but
Or when did Yuan?
I thought the law didn't change because it didn't pass.
No. I know. I'm with you.
Yeah,
I just read something with Mr. Slot of saying I would wait.
you'd wait because it may change.
It may change.
and it may go retroactive.
Yes,
That could be.
but
Okay.
I don't think it's gonna step transaction. I don't think so, because
I-
they're already allowing the backdoor unless they change the law. Then you have to
I agree with that.
unwind everything.
I wouldn't worry about the step transaction. My guess is if they change the law, it'll be for next year, but
Who
you never
knows?
know, right?
Let's move on to Luis. Hello, Joe, Big Al, Andy. I thoroughly enjoy your podcast. It's my favorite financial podcast as it's just the right mix of reliable information and humor. I'd greatly appreciate your insights on my financial situation for purposes of identification. I'm partial to, here we go, 805 ale beer. I drive a Tesla Model Y. I'm 65 years old, married, and recently retired. I have significant RMD starting at 72 based on a projected $2 million in IRAs at 72. Currently about 1.3 million and 80%, 20% stock bond mix. Hold on. It's projected 2 million in IRAs at 72. Currently about $1.3 million, 80-20 stock bond mix. I'm planning to start yearly Roth conversions in 2022 until age 72, sticking about $75,000 to $100,000 a year to at least the top of the 22% tax bracket of my taxable income of about $90,000. My yearly expense will be $140,000. My pension will provide $80,000 of yearly income. I plan to receive my Social Security payments of about $2,400 a month at FRA. I will start taking monthly annuity payments from a deferred annuity in January 2022, which, when added to my pension and Social Security, should cover most of my expenses. I have 2 options for receiving monthly annuity payments. One option is to take the lifetime monthly payment of $1,800 a month. The second option is to take $2,600 a month for 10 years. So that's a little 10-year certain. So Luis would get $2,600 guaranteed until he turns 75 if he took it at 65. I am leaning towards the second option because it gives me more income over the next 8 years when I plan to be more active before I start taking RMDs at 72. Choosing the second option would leave me with no annuity payments after the age 74, so that I would have less income at the same time that I would be taking RMDs and therefore reduce my tax bite. Then, if I opt for lifetime annuity payments, I would appreciate your perspective on which annuity option would make the most sense. Also, whether based on my circumstances, you might feel that taking Social Security at a different point than FRA would be more advisable. Thank you for considering my question and for all your contributions to financial literacy. Regards, Luis.
Yeah, very nice. Formal closing.
Yeah, very formal.
Regards. Do you normally say that in your letter
No.
when you write an email?
He's very formal. It's Luis.
Yeah, I like it.
I love it. Okay. I would not do his plan.
What would you do?
I need to know a little bit more about these annuity options. Is he taking a lump sum, and is he buying a fixed or is it a variable annuity that has a guaranteed income on it? Is he buying an immediate annuity? I'm not sure what that is. or is it an annuity payment from his employer?
Right. That's what I'm assuming.
So let's just assume that if it's from his employer.
Yeah, makes this easier to answer.
Because if it was a commercial annuity, I would not probably advise that route.
Right.
Because what he's doing, he's adding more income on his tax return than potentially he needs to. Right. And all that does is just create a little bit more tax by being locked into a certain rate. I like guarantees. And so if you like the guarantees and you want the guarantees, by all means, take the guarantees. But is there a better way to do this? Maybe to preserve more capital, pay less in taxes? The answer could be yes, maybe yes, right? I would push out Social Security as long as I could.
Yeah.
Because then that's going to increase your guarantee at age 70. Right. So you get the 7% delayed retirement credit each year that you wait after your full retirement age. You have plenty of assets. You're going to have a couple of $1 million sitting in retirement accounts, and you're worried about the RMD that's going to create a lot more tax on you. So you're thinking about this conversion strategy of converting, $400,000 or $500,000 over the next several years, and you'll end up paying roughly about $100,000 in tax. But it could pay more than that because you're adding more income on the tax return. You want to reduce the amount of income as much as possible on your tax return as you're doing a conversion strategy. So you wouldn't want to lock in a high annuity payment if you could, push that out to a later date as you're converting.
Yeah, so that's a good point. So in other words, if you're trying to get as much converted as possible, then you'd actually want to take the lower annuity payment just so you have less income so you can convert more. I actually ran a little math on this, Joe, and this would be at a 6% discount rate, which basically means 6% would be your earnings rate, right? Just if you make that assumption.
So
okay? So in other words, a 10-year certain period works out to about $234,000 present value. In other words, that's just our reference point. It doesn't really mean much. That's just the number. And if you do the $1,800 a month, it takes about 18 years to equal the 234,000. So in other words, then if you just do straight math, if you're going to live more than 18 years, you're better off taking the lifetime at $1,800 a month. If you're going to live less than 18, if you're just looking at this in a bubble, then you would take the 10-year. Now, when you add on Roth conversions to the top of this, I would agree, because it's an $800 difference in payment. Right. And so that's about $10,000. If you took the lower payment, you could do a $10,000 additional Roth conversion each year and stay in that lower bracket until you get to RMDs. I do also like the idea of pushing out Social Security, but we don't have all the facts, Luis, but at least based upon what you told us, that's probably what I would do. I would take a look at what I felt my life expectancy was. I'm actually personally fine with the $2,600 for 10 years. If you need it, if you want to live it up and spend it.
But Luis is very similar to a lot of people as they approach retirement, because you're giving up a guaranteed, or not a guarantee, you're giving up a paycheck, right? You and I receive paychecks from our organization. We're used to receiving, a direct deposit of cash into our checking account each and every, biweekly or monthly. And then when people retire, they want to replicate that as much as they can. Right. So it's like, okay, well, that's why so many people take Social Security so early, because then they feel a little sense of security, no pun intended there, that they get that payment, that they get some cash flow into their checking account. And then it's like, oh, well, maybe I convert this to an annuity and I get this guaranteed income flow. So if the world goes to hell in the handbasket, at least I have a certain fixed income that I can know that I can live off of.
Yeah.
Which is perfectly fine. That is a great strategy if you have that risk aversion. But then if I look at his portfolio, he's 80% stocks. You just retired, right? So he wants to be, he's got his head in, no offense, Luis, you've got your head in the freezer, right? And your feet in the oven, and you're trying to stay warm. You're taking all these guarantees on one side, and you're taking on tremendous risk with your liquid assets on the other side. I think you just want to maybe take a look and run different scenarios just to figure out exactly what he should be doing. If he does this strategy that he proposed, I think he'd be successful. But what's the overall goals? What are you really trying? Is there better ways to tweak this? I think the answer is yes.
Which pension option works best in your specific financial situation? Is a Roth conversion or a backdoor or mega backdoor Roth conversion right for your plans for retirement? When and how should you claim Social Security? You can make these decisions on your own, but if you make the wrong choices, it could mean throwing away money for years to come. Go to the podcast show notes at yourmoneyyourwealth.com and click Get an Assessment to schedule a free financial assessment with one of the experienced financial professionals on Joe and Big Al's team at Pure Financial Advisors. Pure Financial is a fee-only financial planning firm, and they're a fiduciary. This means they won't sell you investment products, and by law, they must act in the best interests of their clients. Get a professional assessment of your entire financial picture and get the help making those decisions that have such a huge impact on your retirement future. Click the link in the description of today's episode in your podcast app, then click Get an Assessment to schedule your one-on-one video meeting at a time and date that works for you.
All right, we got Edward from Virginia. He's got a little follow-up question.
Okay.
He goes, hey, Joe and Al, this is a follow-up from my question on 348. A little delayed answer.
Yeah, apparently so.
Social Security question had to do with me collecting Social Security early so that my younger wife and younger son can collect family benefits up to the family max. A question I forgot to ask. Will my wife's Social Security benefit she receives for caring for our young son and me collecting Social Security be impact if she were to work full-time and earn over $20,000? I know Social Security has rules for me, earnings more than a set amount before Social Security payments are reduced temporarily, but does that same rule apply to my wife collecting family benefit for caring for our minor child? Thanks, as always, for your wisdom and insight. I will toast both with a little something. Lagunitas, right?
Yeah.
So let's kind of break this thing down just a little bit more. So he's collecting Social Security benefits, but then he also has a family benefit. So he has a younger wife and a young son,
Sure,
that can collect as soon as he starts collecting his benefit.
right.
So if he collects benefit, it turns on this whole smorgasbord of benefits for the family.
Possibility of other benefits if your kids and or your wife, it qualifies. And there's two kinds of child benefits. There's the child benefit, which is when your child is I think under 18, I think is the age, and it goes further if they're disabled. So that's a whole nother topic. But there's also a child in care benefit for the spouse. In other words, a spouse that's not working or working very little can take care of the child and receive child in care benefits, which are in addition to the child benefits that the child gets.
And then there's a family maximum,
Right.
that you kind of add up all of the different benefits, and there's a certain max that the whole family can receive.
Correct.
Because Edward, I remember answering this question, is that he's a little bit older and his wife is a lot younger than him, and he has a very young child.
Right.
So he is in his 60s and he's got like a 5-year-old.
Right. And I think the child in care benefit, I think they have to be 16 or younger, or maybe it's under 16, but something like that.
And it doesn't come up very often.
Not very often. Yeah.
Right. And I think we're going to see it come up a lot more often.
I do too.
Because people kind of push off marriage and they push off having kids, and then
Right.
Bada boom, bada bing, you're in your 60s and
And you got a young child.
yeah, there you go.
Right.
But unfortunately, so what he's asking is that there's this rule. So if you claim benefits early, so if you claim benefits on your full retirement age, there really is no reduction of benefits. If you claim your benefit early, so from 62 to 66 in 6 months or whatever your full retirement date is that there's going to be a benefit reduction depending on how much money that you make.
Right.
And there's different thresholds depending on when your birthday is. So the year you turn your full retirement age, right, there's a certain dollar amount that you can make. I believe it's like $50,000.
51,960.
Okay, $52,000. You make more than that, every $3 that you earn, they take $1 back.
Right.
Prior to the age of your full retirement age, if you make more than what is it?
Oh, well, it's 20,000.
Okay.
And 19,560.
Thank you, 19,560. So if you make more than 20,000 every $2 that you earn, they take $1 back.
Right.
It really, what happens is that if you make, I don't know, I forget what the crossover is, but if they make, let's say $60,000-$70,000, the benefit basically goes to zero.
It goes away, right?
Right. But it's not like they're taking your money away. They just assume that you didn't claim it, and then you're going to receive a higher benefit the following year, depending on what your income is.
See, that's a good point. I don't think people realize is if you exceed the earnings for the earnings test and you have some of your benefits taken away, you will get them back later when you actually can receive your full benefits.
Right. Because if you take it at 62, let's say your full retirement age is 66, you take it at 62, you get a 25% reduced benefit.
Right.
So if your benefit is $1,000, you take it at 62, your benefit is $750. But all of a sudden, if you're making earnings and you make more than the earnings test, that wipes that out. They're going to be like, well, you shouldn't have claimed, you made too much money.
Right.
So they're going to take that money back. And then let's say the following year that you don't have any earned income, they're just going to assume that you claimed that at 63. So instead of a 25% reduced haircut, you're going to have a 23% reduced haircut. I mean, reduced benefit.
Call it 18 and a half.
Something like that, right?
Give or take.
Give or take. But the issue that happens is that when people do that, they get the benefit because the Social Security Administration has no clue how much money that you're making until you file your tax return.
Yeah, when the year's already over.
Right. So they're going to pay you.
Right.
And then next year you're not working and you're looking for that Social Security check. Guess what? It's not going to come.
Right.
So they're going to say, okay, even though you qualify for the benefit because you're not working and you are not subject to the earnings test, we gave you the money last year. So we're going to get trued up before any more dollars from Social Security is going to come to you.
Right.
So he's asking, does those same rule applies for my young spouse that is
Correct.
taking care of my child if she is making more than $20,000? And we believe that the answer is yes.
Yeah, the answer is yes. So the earnings test does apply. There's a lot of differences though, but so this is a spousal benefit. It's different from a normal spousal benefit. In other words, when you turn 62 and you're receiving a spousal benefit, if you elect to claim it, your other spouse is claiming benefits, and you're getting half of their full retirement age discounted for the fact that you're starting it early, then you essentially are getting a lesser benefit yourself for life. But in this case, the spousal benefit for child and care doesn't impact your benefits at all whatsoever.
That was pretty hard to follow.
I know it was. I didn't even understand it. I was saying it. It's like,
dude, it looked like you had like a mini stroke.
Who is?
You were kind of thinking about that. Let's see.
It's like,
was that first?
Yeah. You know, when you go down a path and you go, I shouldn't really have done that. But it's too late.
It's way too late. It's on the spousal benefit.
Blah, 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 blah. I had to go way outside the box to get back to the box. Yes, I'm aware that didn't make any sense. So you translate it.
You took a U-turn. But that just made a 360. So the spousal benefit on Social Security.
Yeah, let's see you do it.
Okay. We gotta explain what the spousal benefit is.
I tried.
Oh gosh. All right. So if you're married and you have a spouse, the spouse can claim 50% of your benefit as long as you're claiming your benefit.
As long as they're 62 or older.
Well, if they claim their spousal benefit, which is 50% of your benefit or theirs, if they claim it early at 62, they're going to receive a reduced benefit. It's not going to be 50% of the spouse. It's going to be something significantly less. It's about 33%.
So that's what I said. Roll the tape back.
Yes. However, the reduction of benefit for spousal benefit does not apply to the child and care spousal benefit.
Yes, that's true, which is also what I said.
Thank you.
Anyway, so maybe the two times we said it, someone might have a chance.
Yeah, of the 0.5% of the population that even
that applies
to. I mean, there's Edward in Virginia, and I think there's like Tommy in Wisconsin. Those are the only two that
we know of.
Yeah, in Donald T. in DC.
Yeah, we do know about that one.
He's got a young kid. Saginaw,
Michigan, I guess.
Your Jane writes in, hi, I appreciate all of the great information you put out on your podcast. I would like to have YMYW look over my finances and give a suggestion. Well, that's what we do on the podcast, Jane.
Sure.
Saginaw. I want Al to do it.
Not Joe. What's Al to do?
Wow, she's a little partial to Big Al. I believe he is the most knowledgeable tax planner I've ever listened to or hired.
Wow.
Has she hired you?
No,
She's got a little secret man crush on Big Al.
but it sounds like maybe she wants to.
Oh, Joe is awesome at investments. No, I'm not. I'm not awesome at investments.
Actually, you're very good at financial planning
Yes.
strategies.
I'm not very good at investments. And would appreciate his input as well. You want my input on investments?
Yeah, explain a stable value fund, please.
Yeah, it's a fund that is stable.
Okay. Right, and it's valuable.
Well, the value is
can be.
stable.
Yeah.
Right. The value of it is pretty stable.
Yeah.
So,
okay.
I imagine you hire great advisors, but honestly, I would fly to California if I could enlist Al and Joe's help personally. Is that a possibility? Absolutely not, Jane. Sorry. Thanks, Andy, for keeping the show moving. You all are fantastic. P.S. I like pomegranate juice.
Pomegranate.
What's pomegranate? That's like a red kind of.
Yeah,
It's a fruit with a whole bunch of seeds in it.
Yes, and do not get those on your white shirt. You just have to toss it.
That sounds like it's speaking from experience.
Oh,
yeah,
it's happened, huh?
It's happened.
P.S. I like pomegranate juice with pear absolute for my cocktail, and all day IPA or Miller Lite beer. Okay, no drinks until February. I'm doing the dry January challenge.
Oh, are you doing that? Or did you do that?
Well, it's in February now. Did I do the dry January challenge?
Yeah. Were you talking about that?
Yeah. I made it 3 days. No, it's I didn't do it.
Didn't do it.
No.
I didn't even know about it.
Well,
Otherwise,
I think it's every year. I mean, I guess when you blow out the holidays.
Sure, with the New Year's Eve.
I guess. I don't know. Some people just go on a couple-week bender.
The party for all parties.
Yes.
Yeah.
I mean, your Christmas party after Christmas party
Oh,
after
yeah,
Christmas
right,
party, you
right.
know?
And then the family comes over, then you drink more.
Yeah. Then it's like, okay, I'm shutting this thing down for at least
for a month. I'm gonna go to the gym.
Yep.
Not drink.
Yep.
Gonna eat well.
No, I didn't do that.
Okay.
I don't, I don't drink during the week. It's just
No, you're
like
pretty
on the
good.
weekends.
Yeah.
Because I get up fairly early. If I even have one beer during the week, I would
Kind
I
of
don't know, the next day
throws you off, huh?
it does.
Yeah,
I think
yeah.
it would.
Yeah,
You
yeah.
You like
Okay.
to stay sharp.
Yeah.
Not like you, Big Al, where you just get those IPAs going during your lunch hour.
Actually, that's not true. I might have like a Coors Light each day.
Yeah.
Yeah, but I've learned this about myself. I can handle maybe one IPA on a weekend day is about it. Then if I have two, I get a headache.
Yeah. Well, how about that one time when
Oh,
you couldn't even do the radio show live when we were doing it live
yeah,
back in
I
the
had
day.
4 of them. It was my 50th birthday, which seems like just yesterday, but it was a little while ago. And yeah, I didn't feel that well, did I?
Ugh, yeah. It's like, oh, you got to do the show by
you gotta-
yourself.
so
You can
need to
find
get-
a sub.
Get someone else.
You gotta find a sub.
Well, I remember that one time we in the studio, you told me you grabbed the trash can and you said you're gonna have to carry the show because I may not make it. And that was live radio back then.
That was live.
Remember that?
Yes, I do.
You held it together.
I did.
Yeah.
I was totally fine.
Yeah.
I just had a little flu bug. Which was,
a little flu from the
yeah,
from the bottle, huh?
No, oh no. From just there was some bugs.
Bugs in that beer.
Okay, we got Simonetti.
I think it's Simonetti 1962.
God, I'm so good. I mean, like a year ago, there's no way I could have pronounced that.
Yeah, you're killing it.
Yeah, Saginaw. I mean, I'm totally making that. Love the podcast show. Al and Andy are the perfect team and deliver great content in a light of humor style. This is a little review we got.
Yeah.
So
Okay,
we
cool.
finally got a positive one. So a little 5-star banger here. So we appreciate
Sweet.
that singing that Simonetti. Yeah, usually it's 1 star and you
Yeah,
guys suck, but
Yeah, get You get a thing each week from the ninja.
Yeah.
It's like, when are you going to go off the air?
Folks, this show's not a show without your money questions. So keep them coming each and every week. We really appreciate you writing us. I don't know how you continue to do this, because I just butcher names. I make fun of the questions themselves. You guys barely give us any information to go off of. But we love each and every question. So keep them coming, because the show, we will stop the show if you stop the questions. So bring them in. Thanks for listening. We'll catch you next time. Show's called Your Money Well.
We got little something, something, Luis, Tesla, and what we're watching in the Derails at the end of the episode today, so stick around. Your Money, Your Wealth is presented by Pure Financial Advisors. Click that Get an Assessment button in the podcast show notes at yourmoneyyourwealth.com or call us at 888-994-6257 and schedule your free financial assessment at a date and time that works best for you, no matter where you are in the country. Chances are one of the experienced financial professionals at Pure will be able to identify strategies to help you create a more successful retirement. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Lagunitas, right?
Yep. Yep. It's an IPA
Yeah. I have some in my garage fridge.
that someone brought that you're never going to drink.
Exactly. I mean, people love that stuff. I mean, every time you have a couple people over, they bring this Lagunitas.
Yeah, it's popular here in Southern California. Apparently in Virginia too.
Yeah. Where's I thought it was like a California brew.
Oh, wait, there actually is one that's called Little Something Something, made by Lagunitas.
Oh,
That's actually a brand of Lagunitas.
okay.
All right, a little something, something.
Is it an IPA or is it something else?
It's a little something, something. Actually, Little Something Something is an ale.
Oh, okay. So I stand corrected. I've had the Lagunitas IPA.
Yeah, I know. I think a lot of people have that. I got a ton of it in my fridge. So if you ever want to,
I'll stop by and
stop
have
by.
it. Yeah, okay.
Pop on by. Where's that, Lewis?
I would go with Luis personally, but
You like to have a little flair.
Yeah.
I like to try and do it the way that people would actually pronounce their own names.
Luis. Is that Lewis or Luis?
I'd say Lewis, but I like Luis. I think that's cool.
All right. I mean, if I spelled my name Luis, I would definitely go by Luis.
Luis, yeah.
Well, Lewis would be Louis.
No, that's Lewis.
Oh, yeah.
That would also be Lewis. Both of those would be pronounced Lewis.
Luis could be Lewis too.
Yeah, I'm changing my mind. I like Luis.
Okay, Luis. You know, I got a ride in a Tesla. That was my first time ever in a Tesla.
Yeah, my brother just bought one a month ago. I got a ride over Christmas.
Yeah?
Yeah, that was my first ride too.
Did you like it?
Loved it.
Are you thinking about getting one?
Yeah. Trying to save the planet. One car at a time.
One car at a time.
Yep.
Oh, boy.
Is it
Okay.
like the most exciting thing about the Tesla that as it turns corners, you can make it fart or something?
Well,
I'm not aware of that, Andy.
Yeah,
That is one of the apparently one of the selling points of the Tesla.
brother Todd was the first feature he showed me. was
Yep.
the feature you can pick whatever seat and the sound you want it to be.
Oh, wow. Never heard of that. I didn't get that experience. I did not get that.
Maybe it's an
experience.
older model.
Got it.
That's an upgrade.
Got it.
You have to pay extra.
You watching anything good? You got anything you wanna share?
Yeah, we watched. Let's see. This Is Us. You heard of that?
Oh, jeez. Just sit there and cry. Sob.
Well, I'll tell you what. So we just started it, and honestly, the first 3 or 4 episodes I thought were pretty good, and now I'm through 8 episodes, and I think I'm done.
You're binging. I mean,
Well-
8 episodes in a night?
No, not a night. Maybe 1. But anyway, I did watch one last night, and I'm thinking, I don't need to see this.
Well, it was a.
It's-
I've never seen it.
It's getting. It's just like a contentious family.
Oh,
It's like, all right, I don't need to see that.
it's just like
I like
love and happiness.
Hallmark.
Hallmark.
Where's the Hallmark channel?
Oh, that's your wife. Huh?
That's that's right. Try to be a happy guy.
You are a very happy man. I appreciate that. Have you seen that? Did I talk about this dope stick? You seen that? Andy, have you seen it?
Don't know that.
No, I don't know that
Very
one.
good. That's with Michael Keaton. about the opioid crisis.
Okay.
Yeah, I would.
Is that's a show or a documentary?
Yeah, like eight episode kind
Okay.
of. You know how they don't make movies anymore. They just do like 8-episode Netflix series or
Right,
Hulu
right.
or
Sure.
you know. Do you have the Hulu, Andy?
No.
Hulu?
No, I was going to ask you guys if either of you have seen Get Back, the Beatles
Yeah.
documentary.
No, I did see that
Huh.
advertised, but I have not seen
That
yet.
that I would enjoy, so I will watch that.
Well,
Get Back.
you have to prepare yourself. It's like 7.5 hours long. But if you're a Beatles fan, it's totally worth it. Just to see Paul McCartney come up with the song Get Back out of nowhere, to watch it happen in real time is just stunning. He's clearly a genius. So there
Okay.
you go. That's my review of Get Back.
Okay. That's one I could watch. I'm not going to sit and watch it all at one time.
Yeah,
I could,
no.
I could make about an hour.
There you go.
Yep, that's a hard pass.
There's no murders and mystery.
Yeah,
and
we kind of like this.
shooting.
Yes,
Well, spoiler, George
not
does
happy
leave the
with-
band briefly, so that might be exciting for you.
yes.